Welcome to Money Mindset Channel. Today we're discussing 5 simple tricks to boost your savings. Many people believe that saving is difficult or requires drastic changes, but the reality is that small, manageable adjustments can make a big difference over time. Whether you're just starting to save or looking to boost what you've already saved, these practical tips will help you take control of your finances without feeling overwhelmed. Let's dive in and explore these 5 tricks and how each can help you achieve your financial goals. Trick 1. Automate your savings. Why it works. Automation removes the temptation to spend money before you save it. By setting up automatic transfers, you ensure that your savings goals are met without having to think about them daily. Setting up automated transfers. Most banks and financial institutions allow you to set up automatic transfers from your checking account to your savings account. Start with an amount you're comfortable with, even if it's just $20 per paycheck. Over time, you can gradually increase this amount as you get used to living on a slightly reduced budget. Real-life impact. Imagine automating just $50 each week. Over a year, that's $2,600 saved without having to do anything extra. You can set up your automated transfer to coincide with payday, so you never even notice the money's gone. Additional tip. For anyone with multiple savings goals, consider opening different savings accounts dedicated to each goal. For example, have one account for an emergency fund, another for travel, and a third for major purchases. By automating transfers to these specific accounts, you'll feel more motivated as you see progress toward each individual goal. Long-term benefits. Automation is a powerful way to stay disciplined and reach financial milestones, building a solid savings foundation with minimal effort. By removing the decision-making aspect of saving, you're more likely to stay on track and build consistent savings habits. Trick 2. Track your spending with a weekly money review. Why it works. Tracking your spending gives you a clear picture of where your money goes. With a weekly money review, you can make real-time adjustments, curbing any overspending and keeping your budget on track. How to get started. Every week, spend 10-15 minutes reviewing your transactions. You can use budgeting apps like Mint or YNAB, or simply track your expenses manually in a notebook. Look for patterns, particularly in non-essential categories like dining out or entertainment. Spotting trends. By reviewing your weekly expenses, you'll start noticing spending patterns that might surprise you. Perhaps you're spending more on takeout than you realized, or maybe your coffee habit is adding up to more than you expected. Setting goals based on your spending review. As you track your spending, set a small savings target each week based on your observations. For instance, if you typically spend $50 on dining out, try setting a goal to reduce that to $30 and save the difference. Long-term strategy. A weekly review helps you stay aware of your financial habits, which leads to better decision-making over time. You'll start to see how small adjustments can add up to big savings. Many people find that just knowing where their money goes each week is a powerful motivator to save. Trick 3. Try the 52-week savings challenge. Why it works. The 52-week savings challenge is a great way to build up savings gradually. You start with small amounts so it feels manageable and increase incrementally. By the end, you'll have saved a significant amount without having to make large sacrifices. How it works. Start by saving $1 the first week, $2 the next week, and so on. Each week, increase the amount you save by $1. By the last week of the year, you'll be saving $52. At the end, you'll have saved $1,378, which is a fantastic foundation for any financial goal. Customizing the challenge. If you'd prefer, you can keep the amount you save the same each week, like setting aside $25 weekly. This variation of the challenge may feel more predictable while still yielding a significant amount of savings by year-end. Applying the challenge to different goals. Think about specific goals you want to save for using the 52-week challenge. You could dedicate the total amount to a vacation fund, a down payment, or an emergency fund. Having a specific purpose in mind can make it more motivating to complete the challenge. Increasing motivation. Consider doing this challenge with a friend or family member. Tracking your progress together can keep you accountable and make the experience more enjoyable. Trick 4. Use cash for discretionary spending. Why it works. Cash spending has a psychological impact. It's more tangible, so it encourages you to think twice before spending. Using cash limits your spending to the amount you have on hand, which helps control impulsive purchases. How to start using cash for discretionary categories. At the beginning of each week or month, set a budget for categories like entertainment, dining out, and other fun expenses. Withdraw that amount in cash and only use it for these expenses. When it's gone, you'll know it's time to stop spending. Benefits of cash only for discretionary expenses. Cash-only spending can be a game changer for those who often overspend. With cash, each purchase feels more real, and it's harder to part with. You'll likely find yourself spending more mindfully and cutting back on unnecessary items. Using the envelope system, if you have multiple spending categories, consider using envelopes labeled with each category. Allocate a set amount of cash for each envelope. This approach gives you a clear visual representation of your budget and helps reinforce boundaries. Long-term savings. Cash spending helps you develop strong spending habits over time. As you get used to the process, you may find that you're saving more without even trying. Cash can be a powerful tool for curbing impulsive purchases and keeping you on budget. Trick 5. Save any found money. Why it works. Found money is an unexpected financial boost, such as bonuses, gifts, or refunds. Rather than treating it as free money to spend, putting it into savings can lead to a big boost in your finances without impacting your regular budget. Deciding where to allocate found money. If you receive a work bonus, tax refund, or birthday gift, allocate a portion or all of it toward your financial goals. Consider putting it into an emergency fund, a high-yield savings account, or even an investment account if you're saving for the long term. Real-life scenario. Let's say you receive a $1,000 bonus at work. By choosing to save even half, you've instantly boosted your savings by $500 without altering your monthly budget. Saving any extra money like this helps you reach your goals faster. Bonus tip. Challenge yourself to save 100% of your found money for 1 year. At the end of the year, you might be surprised at how much you've saved from unexpected sources. Additional tips for consistent savings. Avoiding lifestyle inflation. When your income increases, it's natural to want to increase your spending, but this can delay your savings goals. Instead, keep your lifestyle consistent and put your additional income straight into savings. Reducing subscription services. Regularly review any subscriptions you're paying for. Cancel any that aren't bringing value to your life, and you'll free up extra money for savings each month. Taking advantage of cashback programs. Many credit cards offer cashback rewards on everyday purchases. By using these programs and immediately transferring cashback earnings into savings, you can effortlessly grow your savings over time. Conclusion. Achieving financial success and building savings doesn't require major sacrifices. By automating savings, tracking spending, participating in challenges, using cash, and saving found money, you'll make significant strides toward financial freedom. Choose 1 or 2 of these tricks to start, and as you grow comfortable, incorporate more. With consistency and patience, you'll watch your savings grow and find yourself moving closer to financial security.